Phil, thanks for joining us. Really looking forward, as always, to these catch-ups and picking your brain about all things property. How you guys finding the market and the activity out there?
Yeah, it's pretty interesting. Thanks, Rob. There's obviously a lot of stuff happening here in Melbourne with the land tax changes that have come into effect as the 1st of January. They've reduced the land tax threshold down to $50,000.
Wow.
So that's affecting the actual apartment market as well here in Melbourne.
So that means, so just to get an update on that means any property in Melbourne with a rateable value of 50,000 will start to get some land tax. I've got property in Melbourne, so that affects me.
Yeah, a lot of our clients that own units as well weren't paying land tax. Now they're going to start getting stung. So our clients that have got $10 million worth of land value in their portfolios in Melbourne are now getting land tax bills this year of $200,000.
So how do you think it's obviously going to hurt the market there. I assume some people are going to say, that's it, I'm going to sell.
Yeah. Well, what I've found with our clients, they're starting to tie up a lot of their wealth within the family home, capital gains tax-free.
Yeah.
They're selling off a lot of their Melbourne investments, and they're starting to invest interstate. They're looking at funds, commercial property, probably leases where the tenants are paying for the land tax rather than them pay for the land tax.
So contractually in where the tenants pay the land tax as an outgoing.
Yeah, and we're diversifying our clients outside of Melbourne now. It's just too expensive for our clients to run large portfolios in Melbourne.
Do you think this will be temporary, assuming one day government changes over? Has the opposition made any noise about scrapping it, or will they get addicted to the revenue as well?
Well, if you look at the Victorian state in comparison, its debt position in comparison to other states where we've got twice as much debt as, say, New South Wales and Queensland combined. So that's a bit of a concern to us. We will have to pay that debt down somehow. But I think if we get a change of government, there will be a potential change there, and they are lobbying that at the moment.
And have they cut stamp duties, or stamp duty still in place? So it's just a new tax on property owners, full stop.
It's a new tax. So you've got that. You've also got the windfall tax for farming clients that own large parcels of land and they've now been rezoned or changed the zoning into residential. So there's a 50% windfall tax. On top of that, you've also got a vacancy tax. So all of our clients that have worked hard and bought their holiday house down in Sorrento or the Bellarine Peninsula. And then you've also got an Airbnb tax of 7% on top of this. So they're literally really going after the investor, and also foreign investors that own units or houses that don't have any particular tenants in them. They're taxing them quite aggressively as well. So I probably see it as an opportunity because everyone's exiting. No one's buying. But with our clients, $5 or $10 million portfolios, I think if they don't have anything in Melbourne, I actually think it's a fairly attractive time to be looking at the market.
Potentially by the weakness as it's coming through, budget for the land tax.
Correct.
That's fascinating. So it's probably, we might just pull up a level for a little while, and if I can get you to sort of go through for the property market as a whole, some of the bigger headwinds and tailwinds that you guys see across the whole markets. And then what we're going to do is dive deeper into some of those opportunity areas and some of the caution areas to be more cautious about.
Yeah, look, I might share my screen so I can
That'd be awesome.
Let's have a look here. And what we'll do is we'll kind of go through, as you know, we kind of grade every suburb in Australia as a AAA, triple B, triple C, or triple D. Now, with your clients, you probably want to be staying away from those triple C and triple D dominated areas. And traditionally, from our end, we're probably, if we look at Sydney, that's definitely going through a period where, the affordability index in Sydney is now running at 89%. So 89% of a person's income is going to service home loan debt.
Wow.
So really, really challenging to kind of buy the Sydney home at the moment. And
You're seeing pockets though. It seems to me in Sydney that there's suburbs that don't have high mortgages, where
that's true.
prices are still strong. Some of those eastern suburbs and others. I imagine it's a tale of a lot of different suburban stories, but high on overall on average.
Yeah. Well, we're looking like with our particular research, we look at markets where there's there is a liquidity and you have the ability to sell that asset within 30 or 60 days. So in Sydney, Sydney's a very segmented market. You've got your
Yep.
waterfront homes, 50 mil plus. Then you've got your 10 to $30 million homes that are eastern suburbs and almost beachfront. And then you've got the sub kind of 1 to 5 mil kind of residential space. And that's
Yep.
predominantly where we're looking at those affordability constraints. I actually think the unit market in Sydney probably represents better value than the housing market.
And
And
is that partially a flow on around the country where post-COVID initially people went away from units and now they kind of the affordability gaps widened in a
yeah,
lot of places there?
yep, yeah, absolutely spot on. Because when we're looking at the data sets and you can see the signs, if there's a nice healthy gap between the median house price and the median unit price, obviously housing is going to become more and more unaffordable in these blue chip suburbs, and people still want to live in those particular suburbs.
Yep.
And so the apartment markets need to become a little bit more mature, and not everyone can afford to buy the larger house in that blue chip suburb. So the apartment market, we feel over the next 5 to 10 years will mature.
And
And areas,
it's really a suburb story. If someone wants to live in a certain suburb and their price point is $1 million, there's a lot of suburbs in both Sydney and Melbourne where they're not buying houses. They have to settle for a unit. Yeah.
yep, yeah. So those blue chip suburbs, Rose Bay, Double Bay, Paddington, Bellevue Hill, the apartment markets have actually done really well over the long term if you look at their growth rates.
Yep.
What you probably want to be staying away from are, off the plan units in Parramatta and some of those higher density type buildings and apartments, but all the good quality, lower, 6, 8, 10, 12, we'd be actually okay with them as an
Yep.
investment in the client's portfolio.
Yep.
But look, Melbourne, Sydney, Brisbane, obviously the unit markets are constrained. We're seeing a lot of builders from Melbourne move up to the Gold Coast, and they're undertaking significant construction with new development going in on the Gold Coast. And it's starting to tinker all the way along the Sunshine Coast as well, which has been really interesting. So
Yep.
they can't generate the same margins or returns on their developments in Melbourne and Sydney. So they're all moving up to Queensland at the moment.
Is there enough land sites for them? I'm sure there is on the Gold Coast. I know other people we've talked to have said Brisbane, there's just such a shortage of land for decent unit sites. So,
Yeah, yeah. It's an interesting statement. A lot of the activity that we're seeing on the ground is purely going into the Gold Coast. I'm only seeing that increased activity from our Sydney and Melbourne builders moving up there. So I'm really
will
only
that
seeing.
will
Yeah,
that
sorry, go.
lead to any supply gluts, or have we still got such a shortage of properties that it's only going to help fill up that
Yeah.
shortage?
Well, if I show the kind of shortage of
That'd be
housing
great.
nationally, we've got a stock deficiency, see here, of across units and housing of roughly around about 162,000 dwellings.
So that means we're short 162,000 properties in Australia right now.
Correct. And a lot of
Yeah.
that is in Melbourne, Sydney, and Brisbane, because a lot of the new developments that were being built in Brisbane were being catered for foreign investors. They dried up during COVID. And all of a sudden, the apartment market in Brisbane, for the first time, has moved into a slight undersupply.
Yeah.
The apartment market in Melbourne and Sydney is undersupplied because builders can't build at the same margin. So anything established or existing, I actually think you're going to see some growth in the kind of unit market over the next 3 to 5 years in this space, which is really
And
interesting.
is part of that just the fact that building costs more, the market realizes it's cheaper to buy than to build, and it pushes up everything existing compared
Yeah,
to the new? Yeah.
correct. Yeah, so we obviously love buying housing stock for our clients, and naturally you buy an older established house with a good plot of land. the cost of construction increases to build that house. So naturally, over time, the assets, even in some of the regional locations we've been buying, we'll see them go on a little bit of a run as well in the short to medium term. So spot on.
Yeah. So that's nationally. Is that,
Yep.
does that play down into any areas to give any areas a real advantage that you see that you guys are taking advantage of for your clients and buying in?
Yeah, so from our end, we're buying a lot of older style unit blocks. So from our end as a business, we want control over the entire land and the block rather than buy individual units. But we are, for a lot of our super fund type purchaser clients, we're buying assets in Brisbane within, 10 kilometres of the CBD and buying blocks for around 1.5 to 3 mil.
Yeah.
And they're yielding, 5-6%, on those. So actually the yield's
And that's whole blocks that you're buying for those clients.
Yeah, correct. We've thought about separately strating them and individually placing them with individual clients and maybe running a syndicate type scenario. But look, our clients, most of our doctors and business owners are buying them, and putting them into their portfolio. And they're a really good stepping stone to a direct commercial asset or an industrial asset. So look, we're doing a lot of those. We're doing them in Melbourne as well, buying blocks of units because there's people exiting because of the land tax or they need too much work. But if you take a 15 or 20-year view, naturally what we feel is going to happen in Melbourne is you're going to have a lot of investors exiting the market. You're going to see less rental stock on the market. That's naturally going to push rents up. And I actually think rents in Melbourne will probably be the best performing, in terms of the vacancy rate. If I show you kind of nationally, it's already at kind of, if you look at Melbourne, we're running at, sub 1.2%.
Wow.
You see a lot of these investors starting to exit the market because they can't run their cash flows properly or they need to exit. We think rents in Melbourne over the next 12 to 24 months will rise anywhere between 20 and 40%.
And
so
I guess that to some degree pays for the land tax. So what's the land tax coming in at? So for a typical unit or investment residential property, what's the percentage of the land tax there?
So generally, if you've got a house in Melbourne and your house is worth, say, $1 million or say it's worth 1.5 and you've got $1 million worth of land, which you're going to get taxed on, your land tax bill for the 24 period will be $4,650.
Gotcha.
So it's starting to get up there. This time last year, before they increased them, it was closer to $2,500 per $1 million worth of land.
So it's gone up. It's gone up $100 a week. It's not quite that. So if rents go up to do that, it compensates the investors who are buying the weakness at the moment.
Correct. So I look at the Melbourne market as a if you're taking a longer term view, and the fundamentals for Melbourne long term in terms of population growth, education hub, offshore education industry in Melbourne's very, very strong. I think the fundamentals are really strong long term. So from our end, we're going against the trend, and we actually think it's a fairly attractive time to be buying because you've got less competition and your rents will increase.
No, sounds good. And are there any particular areas? Let's pick out a couple of different price points. But for someone coming in with, I guess at the lower end, 700 to $1 million, what would their opportunities look like in Melbourne?
So I'd either be looking at an older style kind of townhouse if they could, or our preference would be to buy a house. But in a northern pocket of Melbourne, you can buy really good quality housing for about $1 million, a nice little terrace in Kensington, kind of Brunswick, Coburg. In Coburg, you're almost buying a 3-4 bedroom house for 1 to 1.3.
And these are gentrifying suburbs too, aren't they? So they're progressively over the last 30 years been gentrifying. And I mean, comparable suburbs in Sydney are way more than that, aren't they? So when you look at the comparisons.
If you look dollar for dollar, long term, you get a lot more value in Melbourne than you do in Sydney.
Why do you think that is? I mean, the populations are different. Melbourne's going to be bigger than Sydney. Yeah. So why do you think that is?
Well, it's a very good question. I get asked that question all the time from a number of I think Sydney's very much a global city now.
Yep.
Melbourne's started to play catch up. The thing with Sydney, you are landlocked. So if you
Yep.
look at the Sydney market, it runs with the contours of the land.
Yep.
So it's very hard to develop. They've obviously got to look at changing some of the zoning implications in Sydney if they really want to keep it as that hub. There's got to be a lot more medium density and high density projects going in as well. Whereas Melbourne, the availability of land and the ability to grow out, it's a lot flat. It's a very kind of easy city to grow out in those growth corridors. So when you look at the 2030 policy that they discussed a number of years ago, they're kind of counting the growth corridors around Melbourne.
Yeah.
Whereas if you look at Sydney's very much landlocked in a lot of those
Sydney's
areas.
got to thicken up rather than spread out, doesn't it? So
Correct,
yeah.
spot on. So they've either got to go up, or they've either got to look at relaxing some of the planning restrictions, because in Melbourne and in Sydney, the ability to get a project or a development approved and the amount of hurdles that you need to go through just to get a development off the ground, and then you combine that with construction costs, it's just too challenging to build.
And does that, while we're on Sydney, because you look around and, I get down that way fairly regularly, and we've got clients in Newcastle and Wollongong, and those markets have been particularly strong. And it would seem post-COVID, with some people only going in the office 1-2 days a week, that area around Sydney, Blue Mountains, Wollongong, Newcastle, Central Coast, are they going to feed off that internationalization of Sydney in terms of for the locals?
Yeah, well, you saw a lot of that happen during COVID, and some of the central coastal areas of New South Wales went up 100% within 3 or 4 years. They did extraordinarily well.
Yeah.
I think you're going to start to see a bit of softening, but the regional areas, or the areas like Wollongong and Newcastle, I actually think, dollar for dollar, they're far better value in that 1 to 1.5 mil space. You can buy. I would much rather buy a really good quality house in Newcastle that I could hold, rather than a 1-bedroom unit in Sydney.
Yeah.
So if you're comparing like for like, I'd probably go the house in Newcastle or Wollongong. But look, the performance of those units in Sydney have been brilliant for our clients over the years. I just don't want to deal with 8 other owners in the building and strata fees and a number of other fees, special levies that get raised. So we're very big on controlling the asset, and if we can do that with a house, we'd much rather go the house.
So if we go back to the property clock, and we might look at the obvious one that certainly you guys have been helping our clients with, quite a lot of people in heading towards Perth. I think if we went back a couple of years, you guys had it as buy value, and it's crept up a little to buy momentum. Do you want to talk through I'm interested for people to understand the depth of your research and what you were seeing a year or two ago in Perth that made you have it firmly as one of the better places to be buying, what you've seen since, and I guess how far you think that has to go.
Yeah, well, it's I think from Perth, in terms of when we originally probably had this catch up a few years ago, the affordability index was kind of running at 26, 27%.
And that's compared to Sydney, we talked about a minute ago, at 89%.
89%,
versus 26. Yeah, it's pretty staggering.
So when you look at the cycles, both Melbourne and Sydney, Perth always operates to the opposite cycle.
Yeah.
So when Perth goes on its natural run, Melbourne and Sydney stay quite stagnant for a few years. We would love to be in Sydney buying again, but from our end, we probably think there's, prices probably increased 8 to 10% last year in Sydney. They kind of bucked the trend. They still held up quite well, but we probably expected prices to fall pre-COVID, and COVID really accelerated those prices. The thing I like about Perth is that the affordability index has gone from 28 to 37. The price to income ratios are still very attractive. They haven't moved too much. When we last caught up, they're running at 5.5 times. They're now creeping up to 5.9.
Yeah.
They still need to get up to 7 or 8 times in price to income before we start to exit that
So
market.
when you say, do you want to explain the price to income ratio for the
Yeah.
audience? Yeah.
Yeah. So basically, when we're looking at price to income ratio, we're looking at we're comparing the income that they're generating against the kind of median price in that particular area, and we apply that across units and housing.
Yeah.
Now, if I look at the price to income ratio for Sydney, the average price to income ratio is running at 14 times. So 14 times your average income, like in order to service debt on a particular, on the median house
And
price.
when you're using the average income, it's the average income for that city or Australia-wide?
For that city.
Yeah, cool. So someone in Sydney, they're buying houses at, if they're earning whatever the average income is, 100,000, for instance, that means 1.4. Yep.
That's exactly right. So you can see that in comparison from an affordability point of view, Perth housing market represents far better value. And you can see, obviously in terms of, there's a nice healthy gap between the pricing of housing. We really saw a period of non-performance in Perth, and what really kind of triggered our interest is when we started looking at the data sets a little bit more closely in kind of 2017, 2018, when we really saw probably the bottom of the kind of Perth market in terms of where it was sitting.
And it had been stagnant for 10 years at that point, pretty much, when the rest of Australia was running. Yeah.
13 years, no growth. Like if you bought a house in Subiaco for 800,000 just for pre-GFC, you would have made no money over 13 years.
Yeah.
So it's taken us a long time to finally suggest Perth. We've never really liked Perth because we don't like volatile markets, but
has Perth grown up from that point of view? You think?
Yeah.
The population growth. What's Perth up to population-wise? I know the projections are continued population growth.
Yeah. No, it's a good question, but look, there's 70,000 interstate migrants moving into Perth. So we're tracking a lot of the interstate migration levels, and they're all moving into Queensland, and they're all moving into WA. So we probably expect, well, one, there's a big issue in Perth at the moment because you've got 70,000 people moving in, and over the next 12 months, there's only kind of 15,000 dwellings on the market for sale. So
a lot of
since
competition.
Since the last time we caught up, 21, 22, even 20 average days on market, it was taking around 30 days for a house to sell. It's now stock houses are trading 11 days. So they're on the market for 11 days and they're moving. They're just simply.
So imagine this is a breakout phase, and which you see often where prices look valuable, sort of everyone gets onto it and it starts to break up with competition. So how do you, typically a market like this, how do you see it play out over the next few years in terms of how long it takes to go up, how far it goes up, and what sort of sustainability? And then I guess the strategy of what you do if you're buying in there now.
Yeah. Well, look, for most of our clients, we're buying assets in Perth between 800 and 1.5 in the housing sector.
Yep.
Mainly in kind of AAA rated suburbs, if we can. Now, we've got a probably 50% growth target on these particular dwellings. We're not going to hold them long term. We've identified Perth as an area to buy in, exit once it does, say you buy it at a mill. Once it's worth 1.5, 1.6, we'll be advising the client to liquidate that property and pay off debt on their non-deductible home, or go and reinvest it and buy something blue chip in Melbourne, Sydney, or Brisbane that they can hold for the long term.
Gotcha.
So 5 to 7 years, 50% is probably our target, and then we'll leave a little bit left over for the kind of owner occupier. Because we've seen a bit of owner occupier lending starting to pick up, and kind of investor lending's picked up as well. And then once that's done, then we'll probably end up exiting. But you look at the vacancy rate at the moment, it's probably got I think the Melbourne and Perth and Sydney markets will probably be the best performing rental markets over the next 12 months. And they've all got their different reasons, but Perth is 0.5%.
It's just incredibly low, isn't it? That's just.
Well,
it's horrible for people renting. It's great for
terrible.
landlords. Yeah.
Like we manage all of our clients' assets, and like to be really upfront with you, Rob, it's actually really concerning. You know, we think the tenant is just as important as kind of buying the property
Course.
well,
Yep.
and it's unfortunate that the tenants are the ones that are getting, you know, basically, you know, they're moving out. If they want to move out, you know, they're having to pay another 50%, 30% more rent
Yep.
than they were originally paying. So we're trying to pull that back. You know, we're telling our investors, well, why don't we just build a really good long-term relationship with the tenant, perhaps get less rent, and then we try and lock in the tenant for the long term, and you know, make sure that we're on reasonably friendly terms, because rents are rising quite aggressively across most of the capital cities. I've
Do
actually,
you guys tap into, or do you have your own then macro position that looks at, okay, with rents rising so much, what does that do for the broader economy? You know, with
yep,
people spending the money on rent, there's less for them to spend on everything else. Does that lead to a slowdown? You know, so is our property, I don't like
yeah.
using the word property crisis because the media uses it so much, but will that lead to slower GDP growth across some of these areas?
Yeah, well, I think, you know, one day force some of these tenants to move out of these particular suburbs that they always wanted to rent in. So it's going to force them into moving into other areas, you know, within close proximity. It's going to force the government to introduce other forms of housing. You know, there's a lot of build to rent projects going up, but there's only 3,500
Yeah.
dwellings under construction. It is nowhere near the kind of stock that is required to help tenants, you know,
And
and they're,
does this ultimately lead to a flight to more regional areas as well? Is it
yeah,
like the ripples in the ponds that slowly pushes out to
yeah,
all around Australia in each state where we get this? People say, I'm going to tap out, whether they're renters or owner occupiers, they tap out and move out
yeah.
effectively.
So I think obviously state and federal, we need to do more in terms of investing in these regional catchments across Australia, you know, so, and, you know, as us as a data business, we kind of want to see those trends. And, you know, we really like Ballarat, we like Bendigo, we like Geelong, we like Wollongong, Newcastle, you know, all those, you know, Toowoomba as well, and all those regionals that have still got that relatively, you know, they're within an hour and a half from a capital city or a major
Yep.
employment centre. I think long term, people are going to be forced into moving into these areas because they just, you know, they're either going to have to pay a significant amount of rent, or they're going to be, as we saw with Sydney, a lot of people moved into Brisbane. They moved along the Sunshine Coast because
Yeah.
they just get a lot more value in terms of what they're spending on their homes, and they get a lot more value in terms of what they want to rent as well, in terms of the rent they're
And
paying.
it's probably a good time to talk about this. You always get these people say, oh, how can property prices keep going up forever? But we've kind
Yep,
of talking on two facts here. Australia continues to grow population wise. The
yep,
quality of the immigration gets higher and higher in terms of, bringing in
yep.
people with money. So it lifts everything, and then you get that pushes to this regionalisation sort of thing. So do you see that as being, the capital cities will continue to grow because they've got that desirability, but also as we keep up, and how important is that population growth to keep all that going?
Yeah, well, I think they've either got a, you know, the issue with Australia that we've currently got is that we've got a massive skill shortage across a
Yeah,
number of kind of key industries. And if you look at the technology industry, they've kind of relaxed, obviously technically skilled tech people, because we just simply don't have enough of them coming in. And it takes a long time to educate them. So we need skilled migrants moving into Australia, or we've got to skill them up by educating them on the ground locally, and that's going to take time. So I really don't see that slowing down. I really
no,
don't see that. I don't see vacancy rates, increasing dramatically, and we simply aren't building enough stock to keep up with that demand. And I think all of our states, in terms of some of their kind of planning and zoning, in terms of, we've either got to relax them, and we've got to create other forms, or even provide some form of discount to developers to help them build or subsidise maybe some of their projects somehow, because this isn't slowing down. Look at this,
No, it's
we have
crazy. Yeah.
500,000 people come in, and where
Yeah.
are they going to rent? Where are they going to live? And we've got 160,000
Are
dwellings short.
I mean, we're seeing it's sitting here in sort of Noosa and the Sunshine Coast. We're seeing that the market kind of responds with things like granny flats, tiny homes on properties, and you're trying to watch council hopefully be encouraging of this rather than discouraging. But it's all these answers from different levels of the market as well as the developments. It's people getting, retirees saying, well, let's put a tiny home in the backyard and we can get 300 to 400 a week for that. It's off $150,000 investment.
Yeah, and we've looked at that as a business for Melbourne and Sydney. These, we don't call them. Oh, well, they're doing a lot more of that in kind of New South Wales, but they've just introduced it in Melbourne.
Yeah.
And those modular homes that you've got a lot of land in these particular areas that they're clearly being underutilized.
Yep.
And you don't necessarily have to develop them, but if you can generate some form of accommodation on those existing lots, and you can rent them out, I actually think it's a great play to kind of subsidize some of the shortfall that we're not building.
What does that do? We've had clients that are talking about doing this. I'm curious what it does to their value of their, let's say they've got a home, they've got some land, they put a modular home on the back, they pick up extra rent. Does it increase the value of their property, decrease it, or we're not quite sure yet?
I don't, generally if I'm looking at true form, as cash flow, it definitely helps with the cash flow of the asset. And we've thought about it purely from, obviously with the land tax implications that are coming into Melbourne, to subsidise some of that. I actually think it makes it less attractive than attractive because you're almost turning into an investment grade type asset, rather than an owner occupier asset. So it becomes a hassle for an owner occupier to go and buy it one day. Because
it's an income play, not necessarily a capital growth play.
Yeah, I personally wouldn't look at it as a capital growth play. I'd say, well, my intention is to maybe one day develop this property. If I can generate some cash flow on this for the next 10 or 15 years, then develop it at the very end, and I can get a modular granny flat for 150 or 200 grand on the site, ease my cash flow, pay the debt down, so it's fully paid off, and then you've got an income generating. You turn into an income generating asset. Completely, I'd be okay with it.
There's some interesting twists to this too, because you also get some families that are looking for properties where their adult kids can stay there for longer, so that or aging mum or dad can be in the backyard.
A lot of our Indian and Asian families that come offshore that move into Lindfield, say in Sydney and some of these catchments, they have their parents living upstairs or on the property anyway. So I think that's a fantastic way of, keeping the folks in the house, and they can look after the kids or still be involved with the family setup.
So at a macro level, what you're kind of saying here is there's plenty of supply demand issues that are going to keep the market strong, and it's dangerous if people say just because the market's gone up, I mean, it's got to go down before it goes up or pause. There's still good demand and supply across the board.
Yeah, the fundamentals are really strong. It's just that some of the affordability constraints are starting to creep in, and we know where Sydney's positioned. We know that Melbourne's at its affordability index ceiling. We know that Brisbane's just under. We know that Sunshine Coast is just under. Adelaide's under, and Perth and Darwin are well and truly under.
Let's have a little dive into Sunshine Coast, and obviously I live for our own property here. And we were talking about this earlier, it appears to be re-rating. In the past Sunny Coast cycles, you had people buy holiday houses up here, but now they're moving here. So we talk about affordability. As the population changes, we're seeing a lot of our new clients that we're seeing have moved from Sydney or Melbourne. They've got international jobs where they're earning really good money, or they're coming off the back of selling in Sydney and it's pushing prices up. But it seems to be re-rating the coast rather than being a cycle that might bust. How do you? I'd love to dive deep into that.
Yeah, so if you look at Sunshine Coast at the moment, I think you're spot on. We thought a lot of the inflow into Sunshine Coast was happening from Melbourne holidayers, basically buying their, their asset in, and they'll buying
I think that's what it used to be. Yeah.
Holiday lifestyle sort of assets. Whereas we saw the impacts of COVID and people moving up there, downsizing out of their larger homes in Sydney. Then, they were selling their homes for 10 mil, and, a $3 million home in Noosa was actually good value to them.
Absolutely.
So it was more of there's been a definite change of people moving up there with the intention to live and educate their kids and stay there for the next 20 years. Whereas it was completely different. If you look at the Sunshine Coast all the way through to kind of 1983, we saw this almost, it was definitely a different kind of market back then, but
that bust post GFC, I know that intimately, and at the top end, it was way more severe than that. We saw properties in Noosa and beachfront other suburbs go from 2 million down to 1.2. It was 40% at the top end, and it doesn't appear that that's likely this time around at all. Yeah.
No, look, our view is that it may even kick again, which is probably going against, but we don't see prices coming off as aggressively as they were during the previous cycles, because you're dealing with a completely different type of owner occupier, an investor out there. They're not short stay. It won't be as volatile as it traditionally has been, and it's probably going to move to very similar rates that Newcastle and Wollongong and some of these regional areas that probably have that more of that stable industry. And if we look at,
that's an interesting way to put at it. More of a Newcastle than a Byron Bay sort of tourist type market.
Yeah, Byron Bay is very dangerous in our view.
I mean, it's a whole crazy place on its own.
Yeah, it's whereas you look at Sunshine Coast, it's now becoming a little bit more diverse. There's a lot more people staying there long term. Healthcare's obviously, the Queensland government have gone on a very aggressive healthcare rollout of, you've seen the announcement of 22 hospitals being built over the next 10 years. And so I think the healthcare system in Queensland still has a fair way to go because of all of the, obviously, interstate migration inflows that.
They're going to keep up with the population growth.
So there's these ripple effects in different industries that you start to see, and you start to see the signs of. And if you look at Sunshine Coast, healthcare and is probably almost 15% of the entire workforce. Construction's now at 12.6%. So they're probably the two biggest industries. But financial insurance, that's starting to grow. Education and training, as more long-term families move up there, you're going to start to see more investment into education and maybe private schooling. There might be a few campuses moving up there as well. I think from our end,
it feels like I moved up here 25 years ago from Melbourne, and the industry was very immature at that stage. It feels much more mature, and I like the way you compare it to a Newcastle, where there's enough critical mass in itself to get this diversification of everything going on. It's fascinating, because I know for a while you guys had it potentially reaching peak, but it's kind of it almost needs rewinding all the time because it finds this extra.
So we don't go clockwise, we go counterclockwise sometimes. And Sunshine Coast has almost gone backwards to where, when we last caught up, what was it, 12 months ago, we had Sunshine Coast past that hold rating. We've now put it almost to the very start of the hold rating in terms of our movement. So if you look at Sunshine Coast, the unemployment rate's attractive. People still got jobs. The price to income ratio is running at 10 times. So it's a little bit, I compare that to Perth purely as an investment. You look at the Perth market, and that's at 5.8, 5.9. This is at 10. So, if we look at probably the change in population, look at this, it's growing at a rate, very, very aggressive rate at 2.6.
I think it's the fastest growing. It's taken over from the Gold Coast as fastest growing regional area. So
that to us, that I don't really see prices coming off, that everyone's talking about. yeah, Byron Bay and some of the central coast areas of New South Wales, yes, different market, but I don't really see it happening on the Sunshine Coast.
And
And job creations. Look at that. It's very
yeah, no,
strong.
it's what it feels like, the local economy. And I think there's also a big bunch of people that live here but don't work here. They're literally still working in Sydney or working for US tech companies, and that's lifting the income. And the other thing, I'm not sure whether your stats, so when you look at income levels for a region, whether that allows for the fact that for a lot of retirees, they don't have a high taxable income. So I'm not sure how that
Yeah.
flows through the stats. They've got plenty of resources, but often Sunshine Coast shows up as lower income, even though there's income around.
Yeah, and they're definitely asset rich.
Yes.
And they've got significant share portfolios, but it's not flowing into their incomes. So I think it's very distorted, and COVID really affected those incomes in all the regionals. Like Geelong was affected because you had a lot of wealthy people moving down to the coast,
Yep.
and Mornington Peninsula, Newcastle. We saw it happen all the way along, and
Absolutely.
it was distorting our data. Like, because we're like, well,
Yeah.
you got people on $1 million moving into Noosa on an income, whereas, you look at the average income, it's like 160. So that starts to play around.
Yeah, we might touch on quickly and just on some of the other cities. Two that have potentially reinvented themselves over the last decade, or not reinvented, but become around, Adelaide and Hobart. So, and Hobart in particular has just changed what it is. It's now a
Yeah.
desirable place to live. It's another one that seems to have re-rated as people make choices about affordability and where they want to live.
Well, you can get a really good lifestyle, and look, we probably missed, as a business, we missed the
I missed
entire
Hobart completely. Yeah.
opportunity, if I'm being very upfront with you. And
Yeah.
we, as a business, we had to make a decision around whether we went Geelong, Bendigo, Ballarat, and we just said, because of the connectivity to Melbourne.
Yep.
But if you look at Hobart, you look at the long-term fundamentals, it has completely changed its investment view. And look, we can't wait to get back into Hobart because prices have softened slightly.
They have. Yeah.
Over the last 12 months. It's very similar to Sydney, where it is landlocked around North Hobart and Hobart. Your ability to develop, because you've got a lot of heritage style homes.
There's a lot of potential views in Hobart too, just the nature of the geography that, it's an area you can see that has a lot of potential long term. As people go, you know what, I'm going to sell up, particularly, there's climate choices here, and I don't mean climate change. I mean, people go, I don't want to live in Queensland, it's too hot. But so they make a decision to retire in somewhere like Hobart. We've seen clients move from Noosa to Hobart for lifestyle and just not wanting to sweat it out in summer.
Yeah, and it's very attractive for people also in Melbourne because they're already used to the cold, so they can move.
It's so close. Yeah.
And for what they can get for $1 million or $2 million, it's amazing value. And you actually don't even have to, Sandy Bay and some of those really beautiful kind of coastal.
Yep.
You can buy a really good quality property there for around 1 to 2.5 mil.
Absolutely.
Get land, get your water view, and it's actually North Hobart. I really like as a suburb. Launceston, a lot of our doctors are in Launceston. The hospital's there. It's a great heritage, older style suburb, so it's very attractive.
No, it's a fascinating market. And what about Adelaide? It seems to have a resurgence. It seems solid these days.
I'm not
not a fan.
We're we run a data business, so every decision is data driven. But if I look at Adelaide, the long-term fundamentals of Adelaide are excellent. It reminds me of Melbourne 15, 20 years ago, before Melbourne became gentrified and posh. Now it's now moving closer into that global Sydney. And Adelaide is just, I just think Adelaide long-term, if you were to move over there, it's very, very attractive. It's affordable. You've got great education. Traffic is pretty amazing.
Everything's 20 minutes away. Yeah.
It's just, as an owner occupier, a lot of our clients we found moved over to Adelaide during COVID.
Is there going to be enough economic growth to support a market moving up, or will it be a catch-up market all the time? Yeah.
No, well, I think Adelaide was the best performing capital city over the last 5 years. It performed better than Sydney, Brisbane.
Yep.
It performed better than Perth. So we deployed over from 2016 to 2020. We deployed just under, we've got about 700 properties under management over there. And we're buying them for about 650 to 700, just nice double front period homes, and they're worth 1.3 to 1.5.
How good's that? Yeah.
And good quality homes in Prospect, which is your Brunswick of Adelaide, or your, so good quality family homes, 3-4 bedrooms on 600 square meters of land within 5 kilometers to the CBD.
So what we're hearing is there's no shortage, despite some people going, oh, interest rates high. We'll come back to interest rates, and interest rates are high, prices are gone so much. Surely property can't go up any further. But we're kind of saying with continued immigration, with continued internal immigration from there, and continued growth of the Australian standard of living, and the Aussies' desire to have a decent house, there's still plenty of opportunity wherever you look.
Yeah. In certain segments of the market, not all, but definitely.
And once again, be selective in your buying. And particularly to take advantage. I mean, one thing we talk about with clients a lot, you can buy somewhere like Sydney or even somewhere like Noosa, knowing in the long run you'll be fine, but it might do nothing for the next 8 years just because of those affordability issues. Whereas you can get into somewhere like Perth, see a gain, and then redeploy that gain as those other areas become more affordable. So to be tactical will probably increase your overall return in the long run, instead of just waiting for the 20 years to do its job, to be a bit more proactive.
And that Sydney will get there, but it's just that it's the opportunity cost of not taking a position in another market.
And it's probably also, it's for a lot of people, you're either in the unit market and you've got those issues you talked about with no control and potentially high costs and hidden issues that might come up with body corporates and all the rest, or you're spending a lot of money on one property and not necessarily with great rent. So good for the super high income earners who need the big tax breaks, but not so good for the mum and dad investors who don't want to spend a huge amount out of their cash flow. So for that entry level, let's pivot a bit, and then we'll start to sort of draw some conclusions. For someone who was coming in for their first investment properties, do you venture out into any of the regions? Do you see any regional areas for people with a budget that's more like 500,000? And I know my philosophy, and I know you share similar. It's always a bit more scary venturing out beyond that 2-hour drive from a capital city. Just the economies aren't as robust. But talk us through some of the opportunities there, some of the potential dangers, and some of the risks of going regional.
Yeah, well, you've really got to look into. So we only really touch regional centres across Australia that have a population of more than 100,000.
Yep.
Now, from our end, we're doing we're obviously looking at kind of Townsville. We're looking at Gladstone. We're looking at some of these areas that we traditionally would never touch. But we need to look at the data sets and get more of an understanding before we say go on those particular areas. So even though we're not buying in these particular markets, it's always important that you get your head around values and what's happening to the industries and employment sectors. I think from a value proposition at the moment for our clients, we're buying a lot of stuff in Rockhampton at the moment, between 5 and 6, and we're getting $450 to $550 per week rent. We're buying kind of 8 to 10 houses a month in Rocky. We're doing some stuff down in Rockingham over in WA, which is the Frankston.
We've seen some of that with some of our clients.
Yeah,
so guys, and it looks fascinating. Rockingham story. Yeah,
they're ugly looking estate style houses. They're very unattractive, but you've got the marina and the bay.
They're close. Right. They remind me of some of the older parts of the Sunshine Coast. In other words, they're just nothing pretty, but it'll get re-rated at some stage.
Correct. And we're already seeing a lot of first home buyer activity occurring in those areas. People are being pushed out of Perth because of the vacancy rate being so low, and they're saying for $550 to $650, I can buy a good quality house. I can buy it on 800 to 1,000 square meters.
Yeah.
The land's worth $450 to $5, and I'm paying $50,000 for this ugly looking 3 or 4 bedroom house. And they are yeah, they're very unattractive. You know, they're not. But
Fair
they're
to say
rentable.
though, if I think about the Sydney market, there's some suburbs in Sydney that still look
Yeah,
like that, but they're all $2
yeah,
million as the
correct.
prices have
Yeah,
gone up.
yeah. So we don't. You know, at the end of the day, we look at the data needs to make sense. We look at
Yeah,
the land value. We look at the house and the rent, and if that makes sense, well, you know, we don't care what color the roof is, or as long as
no,
it's rentable, that's it. And we can. And so they're more trading type assets. So it's really, we've looked at Ballarat values. Ballarat values have actually come off 10% over the last
oh
12
wow,
months.
yeah,
We've really started to see a slowdown in terms of the amount of activity. And for 500, 550, 600, you can buy a really good quality long term. If you're holding it long term,
yeah,
I think Ballarat's an excellent area to invest in still. So if I had the choice between a Melbourne unit or a Ballarat house, I'd probably go the Ballarat house if I could.
gotcha, yeah,
But I think, you know, the unit market in Melbourne is definitely at that value stage. You know, it's at
yeah.
the bottom of the cycle. And I think the unit market is better value than the Sydney unit market because
Certainly like cheaper. I mean, you can't
yeah,
in Melbourne. You can still get units for 400 or 500,000. You can't
yeah,
do that in Sydney. Yeah,
correct. So, you know, and the rents are naturally going to rise. So you can
yeah,
actually buy them on really solid yields. So not that we've ever bought units as a business,
yeah.
you know, in Melbourne. We did in Sydney, but we never bought in Melbourne. But we're now maybe starting to open up and do a little bit more due diligence on those. And they are starting to make a lot more sense than they were 10 years ago.
And I suspect that's going to happen more and more with population growth. It's like New
Yeah.
York. You're not
Yeah.
looking at houses in New York. You're looking at nothing but units because it's grown so much
Yeah.
population-wise, and that's kind of probably a glimpse of Sydney and Melbourne's future. As when
Yeah.
they hit populations of 7 and 8 mil, they're going to just have a much stronger unit present.
Yeah. They're just at the moment, the Sydney unit market is far more mature
Yeah,
than the Melbourne unit market. And it's going to take time. And we need to even change our investment modeling. We will down the track, but we're not
yeah,
prepared to do it if we can buy a
just
house.
yet. Yeah, yeah.
Yeah.
No, and it's fascinating. Um, Yeah, so tell me any really stay away areas from at the moment that you guys have that are just, yeah, you just can't make work numbers wise or data wise, if there's any.
Yeah. We're just finding it really difficult to buy kind of Sydney housing. We're finding
Yeah,
it really difficult to buy Melbourne housing at the moment. We'd love to be buying a lot more, but the cash flows, the ability to service that debt,
yeah,
you got to have at least 50% or more, you know, for the rent to start covering themselves. And
yep,
so from that end, we're staying away from definitely the Sydney housing market, staying away from mining towns,
yep,
kind of growth corridors with house and land packages. We're not interested where there's a lot more mortgage stress.
yep.
So very simple, you know, normal things you
So
should be
there's
doing.
enough, yeah, in sort of starting to say there's enough opportunity for those that are in a position to invest. And obviously, for our role with you guys, we for most of our clients, we're doing plans. Property is part of their plan. Once we
Yep.
know what cash flow and affordability is, then we've certainly enjoyed watching them go to you guys and get some awesome guidance based on research about where they should be buying. And
Yep.
yeah, and it's we've gravitated away from as the market's got more expensive and tougher and interest rates coming back, we just think it's almost madness to buy without some really good insights and advice. And the data you guys have is second to none. My view, we certainly appreciate it. We share it with our clients. The property clock on a regular basis, so I know they sit waiting to see what's moved. And as you said, it's a model. It's not a prediction, and sometimes things go backwards and go forwards. But yeah, that's the dynamic world we live in. But fair to say, buying with research is much better than buying on a whim or the latest hotspot or the latest spruiker zone. Are
Yeah.
there any spruiker zones emerging anywhere that you can see?
There's a lot of stuff, you know, there's a lot of store stuff being talked about. You know, there's people getting back into Port Hedland and Newman.
Oh, wow. Yeah.
So all the mining towns are now going on a bit of a run as well because they hadn't moved for a long period of time, which
Yeah.
was, but you know, you have BHP or one of those larger operators pull out, you know, you can lose 50 to 100% very quickly.
They're highly volatile. Like, yeah, and we
Yeah.
touched on off air on places like Gladstone that have been the roller coaster, not so much a mining town, but
Yeah.
Queensland's got a ton of them. We've seen some horror stories over the years, Bullawheeler and places like this where people are selling well-meaning people an affordable investment that turns out to be terrible.
Yeah.
Lastly, and we'll wrap up from here, interest rates, both
Yep.
whether you bother trying to predict it, where you see it going, and what impact you think it has for investors and the broader market.
Yeah. I think, just thinking conceptually, like the RBA do get it quite hard. They're the ones that are often the ones that get all the blame. If you overlay all the poor decision making from our governments that have got us to this particular point, and we won't go on a tangent, but from our end, we've made a lot of poor decisions to force the RBA into making some of these hard calls. They haven't been perfect in terms of, they made a silly comment around obviously the interest rates not increasing for 3 years.
Yeah.
But look, I think we probably should have been a little bit more aggressive at the start, to increase interest rates. We probably were a little bit slow on the uptake there. I think they're going to be a lot more conservative this time around lowering interest rates.
Too. Yeah.
So people are going to have to ride this out for the next 12 to 24 months. Look at their cash flow, run their cash buffers well.
And it's fair to say, I mean, you go back and I think about where interest rates are right now compared to my whole investment journey, and they're low. 6% is not high when I look at, I've been in property markets for 40 years, and I know they're high relative to the last 3 years, but they're low relative to the last 40 years.
Yeah. The last, when interest rates are at 1.5 or 2%, people don't realize how low they were. This is the norm. People have to get used to the cash rate at 4.3. That is the norm. So you either have to figure out a way to get used to it and manage your cash flow, and then we just need to look at the opportunity around that.
And we maybe get some relief up to about 1%, but we maybe don't as well, depending on how the economy grows. And
inflation is coming back. Like we're seeing all the signs are there, but cost of living and wage growth simply hasn't caught up. Cost of living for those lower income earners is really difficult now. You combine that with increasing rents, like it's challenging for those clients that are earning, say, 200 grand or less, running their households. Like it's challenging.
Absolutely. Yeah. No, and we see it. I see it with my kids and stuff as well, where all of a sudden there's mortgages up to here, and I'm not sure anything's really changed, because I'm pretty sure I remember being in exactly the same position where, when you got young families, that's where you're up to. The ingenuity of us Aussies to keep resolving this and the growth of the country. We are the lucky country. There's no sign of us stopping growing, and I think it's crazy for people to talk about. The fact that we've run so hard that it's dangerous, quite clearly on supply and demand. There's a flaw under property prices in most areas that, barring something crazy happening, that we shut the borders or something, it looks pretty solid. Thank you as always. I love the insights of you and your group. The data is amazing, and look forward to our next catch. So thanks so much, Phil.
Thanks, Rob. Take care. All right. All the best. Bye.
Too easy.